Of real estate financial modeling. Today we're going to be going over the concept of amortization. More specifically, we'll be covering a sample problem on constant payment mortgage. We'll touch base on other methods of amortizing, but we won't go into a lot of detail on them. That's going to be reserved for future videos. We'll just go over that concept and do a sample problem and we'll wrap it up. So amortization is basically the process through which a loan gets paid off. So that will be your borrowed capital from a bank. The most common way of doing this is through the constant payment mortgage. This is not only used in real estate, but it's also used when you take out a loan for your car or for a student loan, or maybe you want to buy a house and you take out a loan to buy a house. So the constant payment mortgage is the most common way of amortizing a loan, but there's also the interest-only way and the custom amortization, which we'll cover in future videos. The constant payment method, it's, like I said, the most common one. So that constant payment gets calculated, and that constant payment is composed out of a portion that goes to paying down the principal and another portion that goes down to paying your interest on your loan. So your interest payments are going to start to go down throughout the life of your loan, and your principal payment is going to be going up throughout the life of the loan. So the way you pay or you calculate that payment is through this formula right here, where PV, amortized loan, that's equal to the present value of the principal. So if you take out a $100,000 loan, that's where you start with. That would be your present value. CP, the constant payment, that's what we're trying to calculate. R is the annual interest. And then I is the number of payments in months. As you can see, the annual interest and the number of payments in months, they're not in the same time unit, so we need to be very cognizant of that when we're working through our calculations. You can do that by hand if you wish, but today we're gonna cover a problem and we'll use the Excel function PMT to calculate the payment for a given loan. So let's jump into a sample problem. A loan with a principal balance of $25,000 is structured as a constant payment mortgage loan. It has a 6% fixed interest rate. We want to know how much interest we're going to end up paying, and we're assuming a 12-month amortization period. Okay. So principal, that would be the $25,000. We know we have an interest of 6%. That's given. 6%. We'll calculate payment in just a sec. We know we have 12 periods, a 12-month loan, and the interest per period is 6% divided by the number of periods. So to calculate the payment, we'll use the payment function. We have a rate of 0.5% per month or per period, right? We have 12 periods, and the present value of the loan is $25,000. And we can put a negative there to get a positive payment. So the way we amortize the loan using the constant payment mortgage is we calculate all of our information, which we have, and then we can structure our table. So at the beginning of the period, we begin with the principal. Our payment is going to be the same for each single period throughout the life of the loan. So we can drag. Now the interest paid will be the interest per period for the remaining balance of the principal at the beginning of the period. So it will be the interest per period times our balance at the beginning of that period. So in this case, it will be $125. We can do an absolute reference on the interest per period. It's going to be the same. We can drag and drop. If you want to find out how much we paid in principal, it's very simple. We're going to take the constant payment, which is the same every month, minus what we paid in interest. And this is how much we paid on our principal. So out of this $2,151 payment, we paid $2,000 for our principal and $125 in interest. So at the end of the period, we're gonna get the $25,000 principal that we started with and subtract the $2,000 that we paid in principal for the first period's payment. And we end up with 22.9K basically. Now the ending balance is going to be the beginning balance of your next period. And then we can just drag and drop all of these. We can drag and drop all of these. We can drag and drop all of these. We can drag and drop all of these. So as you can see, the principal that we pay starts to go up with each period as our interest starts to go down. And then at the end of the period, in period 12, we hit a remaining of $0. And that is basically your check. If at the end of the life of the loan, you don't have a zero, then that means you either underpaid or overpaid. So this is a good check to make sure you amortized correctly. Then we want to know how much we paid in interest. So it's pretty simple. Total interest. So we paid $819 in interest. And we want to find out how much we paid overall on the loan. We paid $25,819, which makes sense because we ended up with a $25,000 loan. We paid back all of the loan plus that interest that we just calculated here overall, and it makes sense. So this is how you calculate and amortize a loan using the constant payment mortgage method. And hope you guys liked the video, enjoyed it, find it useful. If you liked the video, please comment and subscribe. Give it a thumbs up. Let me know what you liked, what you didn't like, and we'll see you next time. Thanks, guys.